So welcome to this video, and in this video we are going to discuss investment appraisal techniques. So we are going to look at different techniques that are used when analyzing an investment. To take you back through what we have discussed in the previous video, in our previous video on investment decision, we looked at time value of money. And we looked at the perspectives of time value of money, the future value, the present value, multiple cash flows, looked at level cash flows, we looked at perpetuity, and then we look at the application of annuities in investment. So in this video, as I said, we are going to look at investment appraisal techniques. But before we introduce the investment appraisal techniques, I'm going to take you briefly on investment processes. So these are the various steps in investment process. So the first step is origination of the proposal. So this origination of the proposal mainly comes from the user departments. They're the one that develop what is needed and where should the organization invest in, depending on what is required by the organization. So in the second step in investment process is what called the project screening. So in project screening, you are trying to look at which project that should we invest in. So in the origination, you can develop different proposals. You can develop different projects. So then you need to narrow them down to few projects that matches the organizational resources and the organizational objectives. So that's the project screening. You are trying to narrow down the different projects that were developed into projects that can be where the organization can invest in. Then step number 3 is the analysis and acceptance. Analysis and acceptance, you now look at the financial feasibility of the project, whether you should accept or you shouldn't accept based on the financial feasibility. That is looking at whether the project is going to add value or the project is not going to add value to the organization. So that is going to be our most important part that we are going to discuss in this video. Then the last stage is monitoring and review. So identifying a project is not an end, but it is just a means to an end. So after you have identified the project, or you have invested or implemented the project, then the process continues. You need to monitor and see whether the project is meeting the objective or the project is not meeting the objective. So these are the various steps that you can go through in investment process. So before we look at the investment appraisal techniques, let's look at project cash flows. So when we talk about project cash flows, we basically mean the cash in and the cash out, or sometimes we say the cost and the benefit. So the project cost, we recognize them as negative, and the project benefit, we recognize them as negative. However, it is very, very important to know or to identify the cash flows that are relevant to the project. So when we say relevant cash flows, what we mean, those cash flows that are going to affect the decision. So they are going to change with the decision that you make in your investment process. So the characteristic of these cash flows, first, for a project cash flow, it should be for a project cash flow, it should be a future cash flow. Future cash flow means that it comes or it is going to be incurred as a result of the project. We don't look at past cash flows. What we look at, the cash flows that you are going to incur as a result of the project, or they are going to come as a result of the project. If a cash flow was incurred in the past, that cash flows, we don't recognize it in our investment analysis. Another one, incremental cash flows. When we are talking about investment, we look at incremental cash flows, increase in cash flows as a result of the project. For example, if you had a project before which was bringing you 1 million, and you have implemented another project and your total revenue is 1.5, our interest is what has increased as a result of the new project you have implemented, not the total cash flows. So in investment analysis, our interest is the increase in the cash flow which comes as a result of the project. We always say we use a principle that what are the cash flow with and what are the cash flows without a project. So you look at what was my cash flows before the project and what is my cash flows after the project. Then you look at the increase that has come as a result of the project. However, this point you need to be very careful because sometimes cash flows can increase without necessarily that you have implemented the project. So you need to be very, very skeptical when you are looking at incremental cash flows. So another issue we can talk about is cash flows. When we are looking at investment, we look at cash flows. Our decision is based on cash flows. And when we talk of cash flows, we mean the cash in and the cash out. So if an investment or if there is an expense and that expense does not result into payment of cash, then we don't recognize that one in our investment analysis. For example, a good example I can say is depreciation. We don't look at depreciation when we are analyzing our investment because it does not involve an outflow of cash. Another important issue is the working capital. So some investment require an investment in working capital. So this investment you will need maybe to invest in inventory, you can invest in receivables, you can invest in cash. So the money you invest in receivable or the money you are going to invest in working capital, we recognize it as an outflow at the beginning of the project. Or in the period you are investing, you are recognizing a cost or you are recognizing an outflow. But at the end of the project, the money invested in working capital is recovered. So you are recognizing an inflow. So that is, you need to be very careful in that. So when you see investment in working capital, the period you are investing in working capital, then you should recognize an outflow. But at the end of your project, you need to recognize the money you invested in working capital and recognize it as an inflow. So another issue is what we call the opportunity cost, the best alternative for foregone. So if we forego an income in order to implement a new project, the income you are foregoing is considered as a cost in the new project. For example, if you had project A and the project A was giving you 1 million, but now you are stopping project A to implement project B. So the 1 million you were getting on project A before implementing project B is an opportunity cost. So you should recognize it as a cost to the new project. So another issue when we're talking about the cash flow is tax. You know, in every economy, you need to pay tax. So the period you are paying tax, you should recognize an outflow. However, we shall discuss this component of tax in our other discussions, in our other videos, where we are going to look at allowing for taxation and inflation. So we shall discuss it in more details, but we need to recognize a tax expense when we are analyzing our investment. So another issue is the interest rate. In some investment, you may borrow money from these financiers. So when you borrow money from financiers, you of course automatically need to pay interest. So the interest you are paying is not considered in our analysis. Why? Because the cost of capital we use to analyze or to discount our cash flows include the interest. So when we are carrying out an analysis, we don't consider the interest rate. So let's look at cash flows that are irrelevant to the decision. So the first, as we have talked about, is a sunker or what we call a past cost. The cost which has already been incurred in the past, we don't consider it in our decision. We always say in finance, bygones are bygones. What has gone has gone. You cannot consider the cost that you incurred some time back to the new investment decision that you are going to take. For example, if you purchased a building 10 years ago and now you want to install a machine in that building, we cannot look at the cost of the building that was purchased 10 years ago. So in this case, the cost of the building currently will be irrelevant cost. But if it requires to modify that building, then we shall look at the cost of modifying the building to accommodate the new machine. But the cost of constructing is irrelevant since it was taken or was incurred in the past. So another issue is the book value or residual value of expenditure or revaluation. So if you revalue assets, the cost of revaluation or the revaluation value is irrelevant. That is the book value of the asset. We don't look at it in our decision. There is no cash flow that was incurred or that was spent on that. Another one is the reapportionment of existing fixed cost. For example, if you are renting a building, already you are renting a building, but in the same building, you want to put in a new machine for producing a certain product line. We cannot look at the cost of renting the building to the new product line because that is already an existing fixed cost. We cannot divide an existing fixed cost. So that one is also an irrelevant cash flow. Another one is depreciation, which we have already talked about, that depreciation is a non-cash flow expense. So because it is a non-cash flow expense, we don't consider it in our decision. So we also look at committed cost. Committed costs are those costs that you need to incur irrespective of the decision. So if the cost has to be incurred irrespective of the decision, then that one is irrelevant cost. We don't look at it in our decision. So let's look at the investment appraisal techniques. So when it comes to investment appraisal techniques, we classify them into two. There's what we call non-discounted cash flow techniques, and there is what we call discounted cash flow techniques. The non-discounted cash flow techniques are those techniques which don't consider the effect of time value of money. So if it is a non-discounted cash flow technique, we don't consider the effect of time value of money. And these techniques, we mainly have two. We have the payback period and we have the accounting rate of return, or what we call the return on capital employed. So let's look at the first one, which we have as the payback period. So if you look at the payback period is the time you take the cash inflows to cover the initial investment. How long is it going to take for your cash inflows to cover your initial investment? So that is what we call the payback period. So when we are making a decision regarding the payback period, we compare the target payback period and the computed payback period. So if the computed payback period is below the target, then we accept. But if the computed payback period is above the target, then in that case, you are going to reject the investment. So let's look at this example, which we got from F9 by BPP of ACCA. So this example, it says that a company with a target payback of 3 years is considering the following two projects. So we have project 1 and project 2, and these are the cash flows that are related to payback to this project. Then we are supposed to compute the payback period. So when we are computing payback period, what we do is to accumulate our cash flows. We add the cash flows where you cover the initial investment. That is going to be your payback period. So let's look at this. So project 1, these are our cash flows. Then we can accumulate. So we have 100, which is this. So on 100, we add this cash flow in year 1, we get 80. 80 we add 30, we get 50. 50 we add 60, we get 10. So meaning we are covering our initial investment between year 2 and year 3. It cannot be year 3 because at the end of year 3 you have a balance. And it is not year 2 because in year 2 you still have the money to cover the initial investment. So meaning we are covering it between year 2 and year 3. So when we are computing our payback period, it's going to be, because you have 2 full years and some months between this period. So you have 2 years plus what you are remaining to cover, which is 50, divided by the amount in your final period or in the period you are covering. Then you put in the bracket, multiply by 12. Then you can get the payback period. So if you look at this one, project 2, we are accumulating. So this is our first initial investment. We add our first cash inflow, we get this. We add our second cash inflow, we get this. We add our third cash inflow, we get this. We add our fourth cash inflow, we get this. So meaning in project 3, we are covering between year 3 and year 4. So when we are computing, we get the cash flows that are remaining to cover, which is this 5,000, dividing the cash flows that we are used to cover, then multiply by 12, then plus the 3 years that you are covering. So let's look at that. So in our first project 1, we said we are covering 2 years. This was the cash flow remaining to cover. This is the cash flow that was used to cover. So it is 50 divided by 60, multiply by 12. Then you are going to cover the investment in 2 years and 10 months. Then for project 2, we are covering in 3 years plus the period between year 3 and year 4, which we can get as the cash flows that we are remaining to cover, divided by the cash flows that was used to cover, then times 12. So we are going to get 3 years and 2 months. Remember, our target payback period was 2 years, was 3 years. Meaning, if you are to select, you are going to select project number 1. So let's look at some of these advantages of payback period. The first one, it is simple to calculate and understand because you just look at the period you are going to take to cover your initial investment. Second, it uses cash flow. In the payback period, we look at the cash flows. We don't use the accounting profit, which is an advantage. It can be used as a screening. So if you look at the tools that are mostly used in screening up a project, it's the payback period. Because if you want to easily identify which project is going to help you to pay back to cover your initial investment, the tool that you can use is the payback period. So disadvantages of this technique, it ignores the timing of cash flows. You don't look at the timing of the cash flows. You don't look at the cash flows after the payback period. So the moment you cover the initial investment, you don't go below the payback period. It cannot distinguish between projects with the same payback period. So if you have 2 projects and the 2 projects are having the same payback period, it becomes complicated to know which project should you invest in. So the last one we can talk about that the choice of the payback period is arbitrary. It is judgmental. It is not based on any scientific method. It is the manager's judgment that we want a project to cover in this period without any scientific method on that. So those are the weaknesses of the payback period, but we cannot ignore the fact that it is the mostly used technique So another technique which is still under non-discounted cash flow technique is the return on capital employed. Sometimes we call it accounting rate of return. So to get the return on capital employed, we get the estimated average accounting profit divided by estimated average investment, then we multiply by 100. So however, to get the average investment, we get the initial investment plus the disposal value, then divided by 2, or initial investment plus residual value divided by 2. Average profit, you get the total profit in different years, then divided by the number of years. So that you get the total, the average profit. So that is what we are saying. To get your average profit, you are going to get the total profit, then divided by the number of years, then you can get your average profit. Then divided by your average investment, then you get the return on capital. So let's look at this example. We have a machine which costs 200,000. Will last for 5 years and will then have a residual value of 50. So this is our initial investment. This is the residual value. So compute the return on capital employed. So let's look at this. So our machine cost is 200. The useful life is 5. Residual value is 50. So to compute our average investment, as I said, you get the initial investment, which is 200,000, plus our residual value, which is 50, then divided by 2, you get 125. Then to get the average cash earnings, you are going to get 230, which is our total profit for the 5 years, then divided by 5, you get the average profit. To get the average depreciation, because we look at the total depreciation in 5 years. So our total depreciation in 5 years will be the total value of the asset minus the residual value, then divided by 5, you get the average depreciation. So if you don't use that, you can as well get the total profit minus accumulated depreciation, then divided by 5, then you can as well get the same answer. So our return on capital employed will be our 46, which is our profit, minus depreciation, then divided by our average investment, and then we get a return of 12.8%. We cannot make a conclusion on this unless you have a target return on capital employed. Advantage of this technique is it is quick and simple to use. It considers the whole cash flows or the whole profit for the whole years. It is relative, so it is the best way to use the fund. It looks at the whole life of the project. So those are some of the So let's look at a detailed example on return on capital employed and payback period before we look at discounted cash flow techniques. So we have this project which has got an initial investment of 0.3 million and will produce results shown below. The project has a residual value of 0.1 million. So advise the company on whether the project should be accepted using the payback period and return on capital employed. If the company has a target payback period of 4 years, so this is our target payback, and a target return on capital employed of 25%. So these are our cash flows. Please, when you have a selling price and a variable cost, we need to compute what we call a contribution margin. So to get the contribution margin, you get your selling price minus the variable cost. Then you can get your contribution margin. So when you get the contribution margin, then you can get your income, or you can get your net income or gross profit by getting your contribution margin times the number of units. So that is the thing we are going to use. You get your selling price minus variable cost, you get a contribution margin, then you get the contribution margin times the number of units, then you can get your total contribution. So this is the information we have in the question. This is our initial investment or project cost. This is our residual value. So from this information, it can be easy for us to determine our average investment. So our average investment will be our initial investment plus residual value divided by 2, then you get 200. So from here we can be able to get our payback period. As I said, to get this net cash flow, we get our selling price per unit minus the variable cost per unit. You get a contribution margin, then you get the contribution margin times the number of units, then you get your net cash flow. Then you can accumulate, as we saw in our previous video, or as we saw in our previous discussion, you can accumulate to get your payback period. So it means in this case the project is covering between 2 to 3 years. So our return on capital employed, as we say, we have already calculated it. Our will be average profit divided by average investment. Our average investment, we have already calculated it as 200,000. So our average profit will be the total profit divided by the number of years. So our total profit, you can add the profits from the different years and get our total profit, and our number of years was 5. So to get accumulated depreciation, you can get the total value of the asset times minus residual minus the residual value minus residual value, then you get your accumulated depreciation of 200. So your average profit, or your average profit now will be average profit will be the total profit minus accumulated divided by 5, and you get 47. So return on capital employed, we will get the 47,000 divided by the average investment times 100, then you get 23.5%. So remember, our target is 25. So it means in this case you are going to reject based on return on capital employed. So dear members, this is the end of this video. So please watch video 4 for discounted cash flow techniques. So please remember to subscribe to this channel to continue watching my videos. Thank you.